We're about to face the biggest crash that has been building since 1990, according to Robert Kiyosaki's interviews and tweets. And judging by how ugly the markets have been looking, he's onto something. In today's video, I'm going to be talking through what you can expect and how you can protect yourself from the crash. We'll also be going through advice specifically suggested by Kiyosaki. If you like the sound of today's video, or you know that you need it, smash that like button. Let's get right into it. First things first, who is Robert Kiyosaki if you're unfamiliar? As I'm sure many of you are aware, he's an author of Rich Dad, Poor Dad, which is pretty much a classic must-read for people who are looking to take control over their personal finance. Kiyosaki is a successful American investor, businessman, financial commentator, and personal finance educator, worth a net worth over $100 million himself. So when he speaks, you definitely want to listen. Now, let's talk about Robert's prediction that the biggest stock market crash in history is still coming. He calls it the everything bubble. Everything is going to come down. I know this might sound like a little dramatic, but let's take a step back and understand what a crash actually is and what the situation currently looks like. Stock market crashes have occurred for a variety of reasons throughout history. Investors realized in the late 1990s that internet companies were not living up to the hype. A housing crisis began in the United States in 2008 before spreading globally. In 2020, a pandemic started it all, shutting down nearly every economy on the planet. But what about now? We appear to be dealing with a whole bunch of issues right now. High inflation, rising interest rates, labor shortages, supply chain disruptions, continued COVID lockdowns in Asia, and an energy crisis in Europe are just a few examples of things we could talk about. All of these factors are slowing down economic growth. And now there are concerns that another recession is on the way, according to Kiyosaki. Some of these things that we can expect to see are that the U.S. borrows too much money and keeps interest rates low. Low interest rates force the U.S. to borrow more money to buy more U.S. bonds to keep interest rates low. This causes inflation, forcing interest rates up. Debt becomes too expensive, and the U.S. dollar dies, which will inevitably impact the whole world. But does this just mean doom and gloom? Not according to Kiyosaki. For most people, that's bad news. But some people can seriously profit during crashes if they go about it the right way and prepare for what's to come. So I'll be taking you through what you can do to prepare for a financial crash generally before taking you through what Robert specifically advises to do during these tough times. There are plenty of steps that investors can take when anticipating a financial crash, and here are 3 of them. Number 1, have an emergency fund prepared. A golden rule of investing is to never invest money that you don't have. A stock market crash is an excellent example of why this rule exists. The last thing any investor wants is to be forced to sell shares in a fantastic company when prices are low. Running out of cash for daily expenses and other financial obligations can severely hurt a portfolio's long-term performance, and it can add years to your journey to long-term financial success. That's why, especially during a stock market crash, it's critical to have an emergency fund. So, how much money should go into this emergency fund? The question has no single correct answer. It's entirely dependent on your personal financial situation. However, a rough estimate is 6 months' worth of savings set aside for a rainy day. Number 2, keep investing, keep diversified. If your portfolio includes stocks with strong underlying businesses, prices will almost certainly recover fully and then some. That's why even during a painful market crash, staying invested is a critical first step. However, stock recovery is never guaranteed. A falling share price may never recover, depending on the circumstances of the underlying business. Diversification is an effective strategy at your disposal that reduces risk. The damage caused by a failed business is mitigated by other positions in stronger companies by not putting all of your eggs in one basket. Great way to think about it. Having said that, how many stocks should you own? Let's ask that question. Again, this is ultimately determined by personal circumstances. However, I personally think it's wise to own stocks for approximately 25 different companies across a wide range of industries. Number 3, stay in it for the long term. It's all too easy to get caught up in the short-term volatility. After all, it's not fun to see a stock drop by double digits for no apparent reason. However, when viewed in the long term, these price cuts may appear to be minor blips on an otherwise upward trend. It's one thing to say this, and another thing to actually do it and live through it and have the emotions happen. Keeping a cool head and a strong stomach during a crash is difficult, especially at certain times, to say the least, especially for newer investors experiencing their first crash. But this crash that we may be facing isn't to be taken lightly. Kiyosaki suggests taking more specific actions to prepare for the biggest crash that most of us will likely see in our lifetime. Kiyosaki advises that investors buy ahead of the crash. And his reason for this is that you profit when you buy, not when you sell. Buying at the top of the market is the easiest way to lose money. It's best to buy during a crash when prices are at their lowest, so that when the markets do eventually recover, you can sell at a relatively much higher price and make much more profit. But what should you invest in? The main attitude that Robert Kiyosaki adopts can be seen in his words. Anything that can be printed, like a stock certificate, a bond, or a dollar, I don't want it. So what would Robert prefer investing in, bearing this impending crash in mind? Number 1, precious metals. Precious metals, particularly gold and silver, have been regarded as the safe haven against inflation and uncertainty. They cannot be printed out of thin air like fiat money, and their value is largely unaffected by global economic events. So it makes complete sense that Kiyosaki is buying more gold and silver as additions to his portfolio. It should be noted that precious metals have not been immune to this year's sell-offs. In 2022, the price of gold has been down about 9%, while silver is down nearly 20%. But Kiyosaki anticipates new revival. He expects silver to stay at least $20 for 3 to 5 years before climbing to $100 to $500 himself. He says that everyone can afford silver and that the accumulation of silver now is essential. Kiyosaki also agrees with investing guru Jim Rickards, who once predicted that gold would reach $15,000 per ounce. Kiyosaki doesn't believe that $15,000 for gold is out of the question. While there are numerous ways to gain exposure to gold and silver, Kiyosaki prefers to simplify and buy the metal. Robert prefers to simply buy the metal itself. He stated earlier this year that he only wants real gold or silver coins, not ETFs. And again, this makes complete sense. Kiyosaki buys gold and silver for one reason. If something bad happens, he can spend the gold or silver anywhere in the world. This is an excellent way to reduce risk. Number 2, Bitcoin. Some believe Bitcoin is the new gold. While Kiyosaki is a self-professed gold fan, he also appreciates the world's largest cryptocurrency. Of course, Bitcoin is extremely volatile, so it's helpful to look at how Kiyosaki got in during one of the big pullbacks itself. Kiyosaki watched when Bitcoin first hit $20,000 and he traced back down. He knew it was picking up momentum when it came back up and hit $6,000. And when it reached $6,000, he purchased 60. So he was in the money. As we know, Bitcoin then went on a wild ride, peaking at $68,990 in November of last year, and today Bitcoin is worth around $19,000, a staggering 72% drop from its peak, but still well above Kiyosaki's entry price. Looking ahead, Kiyosaki is optimistic and bullish on blockchain and is willing to buy at the dip again if the downtrend ever continues. Number 3, food. Food prices have been rising due to global supply shortages, and this is something that investors should be aware of. Inflation is about to explode. In June, Kiyosaki tweeted that the best investment are cans of tuna and baked beans. He explained that while you can't eat gold, silver, or Bitcoin, you can eat tuna and beans. Another interesting thing that Kiyosaki is currently investing in is livestock. He buys Wagyu cattle. Investing in farmland is a popular option these days. After all, Bill Gates is the largest private owner of farmland in the United States. Seems wise, right? Retail investors are also getting in on the action. Retail investors may find it more difficult to enter the cattle market, but the payoff may be worthwhile. And Robert Kiyosaki says, in the worst-case scenario, you can always eat the thing. And that's it for today's video. If you found this information helpful, be sure to like, comment, and subscribe to the channel. See you next time.